Hello, this video is recorded as part of the accounting course by Dr. Ron Lazar. The purpose of this video is to analyze Beta Corporation. This is Exhibit 2 in the Statement of Cash Flow 3 example HBA's case, and the idea is to follow questions that we have in the case and try to get an idea about the company and its position. We have three groups of questions. The first group has to do with answering regarding the statement in each year. Then we're going to talk about trends, and in part 3 we will try to summarize the information that we understood from part 1 and 2. Before we start our analysis, what I would like you to do is take a moment and review the statements and think about where would you rank Beta? Where would you rank Beta on a scale of 1 to 5, when 1 indicates the company is close to declare bankruptcy and 5 indicates the company has outstanding cash flow and we don't really observe any issues or problems. So after you paused and chose your ranking for Beta, let's start the analysis itself. As I mentioned before, the analysis would follow the different questions from the case, and we would try to see how those numbers show in the statement. The first question we have is, what were the firm's major sources of cash and major uses of cash? Let's answer the question for every year we have. If we start with 89 and look at Beta Corporation, we are looking for the largest positive numbers, largest positive inflows for Beta. The largest inflow for Beta in 89 came from financing activity. Specifically, that number, while we had the proceeds of subordinated debt. We issued debt, we got a loan or issued bonds and got positive 4.4 million for them. The second largest source would be the net cash generated by operating activity. We need to remember that we cannot use the components of operating activity as an answer to this question, but we can use the bottom line as an answer to the question. In a typical analysis, I would try and go for the third largest amount, but in this case the third largest positive amount would be significantly lower than any of the other amounts we have here, and I wouldn't even go there. So we found two sources: net cash generated by operating activity and the subordinated debt we issued. Next, we are trying to understand what did we do with the cash, what were the major uses of cash. The largest use of cash in 89 was capital expenditures. We used 3650 to buy property, plant and equipment or any other assets that would be used in our operation. Second largest use of cash would be payments under working capital line, and again the third largest would be significantly lower, and I won't go there. Let's try to answer the same questions for 1990. In 1990 we have a shift. The largest source of cash is the operating cash flow, and we don't really have a second largest source of cash. So operating activities would be the only source of cash for Beta in 1990. The use of cash is both under investing and financing activities. We see that we used 4.6 million for capital expenditures, and we used 2 million to pay back our working capital line of credit. Again, after those two, any other number would be significantly lower than that, and I won't go there. I'm moving to 1991 and to answer the same question. The first one, we're looking for the sources of cash, and the largest sources of cash in 1991 would be issuance of stock. We generated over 23 million from issuance of stock. We also generated a nice positive amount from operation, not as large as 1990, but still almost 4 million, 3.9 million out of operating cash flows. What did we do with the cash in 1991? Well, we purchased marketable securities. We spent 8 million purchasing marketable securities. Those are typically available for sale liquid securities that we purchased. We also used the money to acquire assets, capital expenditures, property, plant, equipment, or any other assets used in our operation. And we also used 5 million to pay back our subordinated debt. So with that, we answered the first question, and we're ready to move to the second question in the case. The second question in the case requires us to examine the cash flow from operation with respect to net income. Which one is larger? And we need to explain in detail the major reasons for the difference between these two figures. In our case, the statement of cash flow is slightly different than alpha, and actually slightly different than gamma. The reason is we're using the direct method. It's very rare to find the direct method in financial statement of publicly traded companies, but it's being used over here. Typically companies would use the indirect method, but companies who use the direct method are required to provide us with a reconciliation of net income to net cash flow generated by operating activities. As you can see by the bottom part of Beta's statement of cash flows, we have another explanation to how we get to cash flow from operation. The numbers I just indicated on the bottom of the page are exactly the same numbers as we saw before under operating activity in the main statement, but we explained them in a different way. In the top part, we explained them by looking at actual inflows and outflows, collection from customers, and payments to suppliers and employees. But on the bottom part, we start from our net income, or net loss, in this case net income, and we reconcile net income by adjusting it for non-cash items or changes in working capital items up to the part when we can explain net cash generated by operating activities. So let's answer the question we were just required: which one is larger, net income or cash flow from operation? So in 89 we see that net income is 417,000, the net cash generated by operating activities 3,670,000. So cash flow from operation is greater than net income. What are the main reasons for that? Well, a reason that typically comes back again and again would be depreciation. We know that depreciation and amortization would show up on the income statement, but the depreciation and amortization is a non-cash expense. Since it's a non-cash expense and we are trying to reconcile net income to cash from operation, we add back the non-cash expense. We have some other items showing under working capital amounts, but we are going to discuss those further. If I'm looking for the largest amount, well, I can see that we have an increase in accounts payable, which means that we got more credit from our supplier, and that would explain why we were left with more cash from operation than what we see as the result in the income statement. The same question, let's apply to 1990. 1990, the net income is 5,201,000. Cash from operation is 7 million. So again, cash from operation is greater than net income. The main explanation is the adjustment for depreciation and amortization, the non-cash expense. In 1991, our answer changes. In 1991, our net income is 6,323,000, and net cash generated by operating activities is only 3,919,000. So we see that cash from operation is smaller than net income. Well, the main adjustment that we see here are still the depreciation. We also have increase in accounts receivable, and we can see that there is also a significant increase in accounts payable. With that, we are done answering question number 2. Typically, we can answer question number 2 out of the main part of the statement of cash flows, but not in this case. I'm going back to the questions that we have, and question number 3 require us to understand whether the firm is able to generate enough cash from operation to pay for all of the capex. How would we answer that? We would go to the investing portion of the statement and look at the capex amounts. we know that the capex in 89 was 3,650,000. Cash from operation was 3,670,000. So we had enough cash from operation to cover the capex. In 1990 we have more than that. We generated 7 million from operation. We need only 4.6 for capex, so we have more cash than we need, and we definitely covered the capex by our operating activities. Again, it changes in 1991. In 1991 we spent over 6 million on capex, but we generated only 3.919 out of operation, cash from operation. So we did not have enough cash from operating activities in order to cover our capital expenditures. So this was the answer to number 3. Next, we're being asked about the cash. Was the cash enough to also cover dividend payments? So if we had enough cash to cover capex, did we have also enough cash to cover dividend payments? In 89 we really had enough cash to cover only the capex, but let's try and look if we even have dividends. We should look for dividends under financing activity. In this case, financing activities, we don't see any dividends and we don't see any share buybacks, any treasury shares. So we don't really have an update in question number 4 regarding the situation that we had in number 3. For all 3 years, Beta Corporation does not pay any dividend, and that's why our answer for number 3 still holds. We are back and we are at question number 5. Question number 5, we're being asked, if it did, how did the firm invest its excess cash? As we explained before, in the year 89 we didn't have any cash left, so number 5 we don't really have anything to answer for number 5. But in 1990 we did have cash left. We had over 2.4 million left after we used the cash from operation to pay for capex. We can look at the second largest cash outflow, and that would be the net payment on the working capital line of credit. Basically what we did with the additional cash amount, we paid back our overdraft. We paid back our line of credit in 1990. In 1991, since we did not have enough cash from operation to cover our capex, we don't need to answer number 5. But on the other end, what we need to do at this point, we need to answer number 6, because if we did not have enough cash from operation, we need to understand what were the sources of cash that we used in order to pay for the capex, and if in case that we have dividends. Not in our case. In our case we don't have any dividends. Let's go back to the statement and look at the largest cash inflows. We see that the largest cash inflow in 1991 was cash we got from issuing shares. So we invested in capex from money we got from our shareholders, money that we got from issuing shares, and that would be our answer to number 6. I'm going back to the question, and we have now a question about the working capital account, where the working capital accounts, other than cash and cash equivalents, primarily source of cash or uses of cash. In an indirect statement of cash flows, we would answer that question out of the main operating part. We would go and look at the changes in working capital accounts, typically at the bottom of the operating portion. In our case, we don't have the indirect method, we have the direct method, and that's why we would go to the reconciliation portion of the statement. Under the reconciliation portion, we are after the changes in assets and liabilities. Those assets and liabilities are the typical working capital accounts, and we want to try and see what was the change in those working capital account. The signs are a bit confusing over here. Let's try and do it slowly. We already know that negative amounts for assets indicated there was an increase in those assets. What we try to understand is first what happened to cash. If I would go and summarize all those numbers together, I'm looking to see, do I have a positive number or a negative number? Obviously large positive or large negative would be important for us as well. Overall, those four numbers would come up with a positive amount, and that means that working capital accounts were a source of cash. We generated cash from the working capital accounts. It also means that the working capital accounts went down, and that's why they were a source, those were a source of cash. Let's answer the same question in 1990. In 1990, we see that summarizing those three numbers, we would get a negative number. That indicates that working capital accounts were a use of cash. We invested cash in working capital, and that means that working capital went up. We had an increase in working capital, and we invested cash into it. In 1991, summarizing the information would give us a large negative number, mainly because of the increase in accounts receivable, and that means that working capital accounts were again a use of cash. We used cash to finance our receivables. We offset it a bit by increase in accounts payable, but overall we invested cash in working capital, and working capital accounts went up. With that, we answered all the questions in the first part. We don't have any other major items affected the cash flow, and we are done with part one. We're moving to the second part, where we need to look at the trend in the different item. So the first trend, we're looking at the trend in net income. If we're looking for net income, we'll find it under reconciliation, and I really like the trend in net income. Trend positive, and nice jump from 89 to 90, from 417,000 to 5,201,000, and less of a jump, but still a nice increase in net income from 1990 to 1991, from 5.201 million to 6.323 million. So overall answer, we have increase in our net income from 89 to 90 and from 90 to 91. The second trend we're looking for is the trend in cash flow from operation. In order to look for that, we're looking at the top of the statement, and we can see that there was a nice increase in cash flow from operation from 89 to 90. We increased our cash from operation from 3.67 million to 7 million. Well, the trend changed from 90 to 91. We had a decrease in cash from operation. We had increase in net income, but we had a decrease in cash from operation. Continuing with that, we're looking at the trend in capex. Over here we have consistent numbers. The trend in capex went up from 3.65 to 4.6 to 6 billion. We can also try and answer the question, did we invest enough in growth? Meaning, do we invest enough in assets in order to replace the capacity that expires every year, the capacity that we used every year? In order to answer that, we need to compare the capex amount to the depreciation on the income statement. Depreciation numbers are showing under the reconciliation, and what we can see in 89, 90, 91, in all those years, that capital expenditures amounts were larger than depreciation and amortization. That would be an indication that we invest in our asset base is going up every year. The company is probably growing at this stage. We're moving to the next trend, and the next trend has to do with dividends. We already answered that there are no dividends for Beta Corporation. If there were dividends, we would look for them under financing activities. And then we need to answer what happened to our net borrowing. So our net borrowing, we would look for the information under financing. Well, under financing activities, we can see that in 89 we were still borrowing. We borrowed on our subordinated debt. We paid a little bit back on a line of credit, but we mainly borrowed 4.4 billion on the subordinated debt. We paid back a bit of our line of credit for equipment and some capital lease obligation, but those are not major amounts. The trend shifted in 1990. In 1990, we already paid back. So we mainly paying back in 1990, and we also mainly paying back in 1991. So to summarize the trend, we borrowed in 89, we paid back some amounts in 1990, and we paid back more of the amounts in 1991. And our last question would be looking at working capital accounts. What was the trend in working capital accounts? As we answered earlier about working capital accounts regarding the inflow outflow of cash, we see that in 89 working capital accounts still went down. We generated cash out of them. It changed in 1990, the trend changed, and in 1990 we increased our working capital accounts, but not by a lot. The overall amounts over here are not that significant. It shifted to a much larger increase in working capital accounts in 1991. The major change in working capital accounts would be with relation to accounts receivable. We invested, we have much more account receivables this year. We have 10,837,000 increase in accounts receivable, and that would mean a significant increase in working capital accounts in 1991. So with that, we are done answering all the questions from the case and all the technical questions from the case, and we need to get to the end and provide our assessment of the financial strengths of this business. So I'm not sure where you guys stand in terms of the earlier vote, but so far what we saw that the company generates positive cash flow from operation every year, that it invests in capex, and it has stock issuance in 1991. And then we also see that they rely now more on equity than debt because they paid back lots of their debt, while in 89 they were still borrowing. So I'm sure that our position should be relatively strong. The question is, how strong should it be? Should we rank it as 5, or should we rank it below that? Please take a minute, maybe pause, and think about any indications that might cause you not to vote as number 5. Are there any indications for issues with the cash flows? So coming back, let's look at the most alarming number that we have over here. In 1991, it seems like that the change in accounts receivable is very extreme. Also the change in accounts payable, but the change in accounts receivable more than before. And the question that we need to ask is, are those real sales generating those receivables? Do we have any earnings management? Did we have any collection issues? Did we change our credit policies? Do we extend much more credit before in order to bring business? Did we have any reversals, any write-offs in the following year? So we don't have answers to all of those, but we might be able to understand what happened over here by trying and use some of the information from the direct method. We know that net income increased very nicely from 89 to 90 to 91. I'm trying to understand what was the trend in sales. Was the trend in sales revenues in the income statement similar to that? And in order to do that, I would go back to the cash received from customers. This is basically our collection. This is our collection every year. And what I want to do is to understand, based on that collection, what happened to sales revenues, accrued sales revenue on the income statement. I know that the collection increased every year, but let's see what's the trend in the sales and what can we say about it. In order to do that, we're going to do a bit more of accounting. We are going to use what we know about accounts receivable. We know about accounts receivable that we have a beginning balance on the debit side. We have an ending balance on the debit side as well. And ignoring write-offs for now, we have two major amounts that would impact this account. We have the sales or revenues on the debit side, and we have the cash collection on the credit side. So looking at those numbers, let's analyze the accounts receivable for 89. I don't know the beginning balance, but I do know that my ending balance was higher by 1550 than the beginning balance. And I would plug that number. Why? Because I know from the reconciliation that there was an increase in accounts receivable. I also know from the direct method that my collection from customers was 51,110. So I would put 51,110 under the collection. And now I can figure out the missing number. The missing number would be the sales for the year. Looks like the sales for the year are very, very similar to the collection, a bit higher, 52,660, and everything seems fine. Moving and doing the same for 1990, I'm going to use different numbers just not to confuse us. In 1990 we had, let's say, Y as a beginning balance and Y plus 613 as an ending balance. The 613 comes for the additional increase in accounts receivable. Well, looking at the direct method, we know that collections were 73,273, so I would plug the number on the credit side, and I can figure out that the sales revenues for the period were 73,886. Going through the same exercise, and I know that it's boring at this point, but there is a point to it. To 91, we would again place the beginning and ending balance. This time we have that extreme number, the 10,837, as a change in accounts receivable. So I would add the 10,837. And looking at the direct method, I would take the 83,865, putting it under the collections part of accounts receivable. I would get that the change in sales is the sales for the period would be 94,702. What can we say about the trend in sales? Well, there is a nice increase in sales, over 20 million, around almost, I would say, 40% increase in sales, and that increase in sales also came with a very nice increase in income. What is it? It's probably 12 or 13 times the income we had in 89 in 1990. Net income went up by a lot. If we continue with that and looking at the change in sales from 90 to 91, we see an additional 20-something million increase in sales, but the question is, what would be the increase in sales without being so generous with our customers and trying to collect more firmly? The question is, if we would not allow for this large increase in accounts receivable, will we be able to generate that increase in sales? And that increase in sales resulted also in a nice increase in income, but not such increase in income as before. The increase is maybe about 20% from 5.2 million to 6.3 million. So what happened in 1991? Why was the company so aggressive in allowing customers not to pay on time or generating much more business on credit, on account, and not in cash, or not collecting it in cash in 1991? The answer to that would be under the financing activities. Under the financing activities, we see that the company issued common stock, and that was actually the first public offering. That was their IPO. The company went public. What does a company want to show before they go public? A company would like to show growth. How do we show growth? Sometimes we would show growth by extending more credit to customers and generating the sales, not worrying about the cash. Why we're not worrying about the cash? Well, the cash would come from the IPO. We don't really need the additional the cash right now. We know that we would get it if we would show successful result in terms of income, growth in sales, and the money would come from shareholders and would help us finance our operation and continue our growth. So my answer to the question over here would be that the company is doing great, but I would not rank it as 5. I would rank it at 4, and again that would be my selection. It's not, I'm not claiming for a second that that's the correct selection. My reasons for placing it at 4 would be I would like to see what happens with those receivables next year. If I would see that those receivables were collected with no issue and that we continue to see increase in sales, then I would probably move my vote to number 5. But given that I don't have the answers to that, and I'm not sure if we didn't have any earnings management over here in terms of channel stuffing at the end of the period, or any game with recording revenues that are not completely appropriate, then I would place it at 4 and not at 5. But it might be that you look at it in a different way and you place it at 5, or maybe you look at it as a more severe of an issue and put it at 3. So that would be my overall answer to beta. There is one more thing that I would like to indicate in terms of what did they do with the cash. Well, they got over 23 million in cash. What did they do with that cash? Well, they left a lot of cash on hand. So they increased their cash this year by 6.8 million, and they have 12 million in the bank ready to be used. They used to have only 5 million in the bank. It might be that they are planning some acquisition, maybe of a company, maybe more of property, plant, and equipment. They also, since they had so much cash and that cash need to be used later on, in the meanwhile what they did, they bought marketable securities. Those are probably very non-risky marketable securities, and they would serve as a way to store, to park that money until they need it for their use, extension, growth, and operation. So that would conclude the analysis of beta. Thank you very much.